Hello, how are you? Today we are going to talk about a topic that is fascinating and that has to do with one of the biggest crises in history. September 2008, one of the oldest and most powerful banks in the world declares bankruptcy. In a matter of days, ATMs around the world were on the verge of stopping giving money. The global financial system has peered into the abyss. Many believe that financial crises appear suddenly, don't they? Overnight, like a black swan that cannot be predicted. The reality is that the 2008 crash, the famous subprime mortgage crisis, was built brick by brick for years in full view of everyone. Today we are going to analyze chronologically how the greatest financial disaster since 1929 was conceived. But most importantly, let's look at the parallels with the current market. Are we ignoring the same alarms today as in 2008? Welcome to Konovan Finance. Today we disarm the subprime crisis. If you have a mortgage or just want to understand how the world works, stick around until the end. Well, the most incredible thing is that it all started here in houses like this, and with a term that almost no one understood but changed everything. Subprime mortgages. After the dot-com bubble on September 11th, the Federal Reserve lowers interest rates to 1%. Why? Because he had to reactivate the economy. The money was given away. Banks need to place that money, and what do? They find the perfect business, the real estate market. The message was crystal clear. Everyone should own their home. Home prices were going up year after year, so banks thought, what's the worst that can happen? If they don't pay, the house will be worth more and we get it back. This is how ninja credits are explained. What is ninja credit? Banks lent to anyone. No income, no job, no assets. In other words, they have no income, they have no profession, they have no assets because they assume that the price of properties never goes down. What was the financial alchemy of all this? The issue is limited to one term. CDO, collateralized debt obligations. The bank takes thousands of these junk mortgages, packages them in a financial derivative, which is the CDO, and the rating agencies, which are responsible for saying whether a debt is of good or bad quality, due to complicity or incompetence, give it the AAA label. Maximum security. The wolf in sheep's clothing. This is where subprime mortgages were born, loans granted to people who had no fixed income, stable work or assets. But for the banks this was not a problem, but a business opportunity. When they see money, they dive in headfirst. Where does this term subprime come from? Well, sub we know that means below. Prime refers to prime rates, the benchmark interest rates that banks charge to their most solvent corporate customers with a perfect credit history. So, subprime, what its meaning is literally below the optimal or below what's premium. What was the great deception of 2008? The crucial problem of the crisis was that banks began to run out of good quality mortgages, that is, people with stable incomes and good credit history. In short, those who can pay and will not have problems. To continue feeding the machine and setting up the CDOs, they began to massively grant the famous ninja loans to people without income, work or assets. They put these junk mortgages at the bottom of the stock market and, through mathematical tricks and the complicity, perhaps, of the risk rating agencies, they managed to get the AAA rating received. That is, they sold to large pension funds, universities and international banks a product classified as safe as a government bond, when in reality it was supported by people who were not going to be able to pay their house in the second installment. What happened when interest rates rose and mortgage payments became more expensive? The CDO's base completely collapsed, causing the entire financial structure to collapse at once. Because the CDO was made up of levels, at the base it had all these junk mortgages, then I had in the middle some debts that were not junk but were not perfect either, they were of an intermediate level where obviously the income through the rate was also intermediate, and a high level that was made up of people with an excellent credit rating so less was charged because the risk was lower. But the whole financial structure collapses suddenly because the base falls completely. The rating agencies that were supposed to monitor them put a seal of safe investment on them. It was like selling a box of bad apples saying they were top quality because they were wrapped in fancy wrapping paper, but inside that credit product was a lot of debt that had a lousy rating. So what happens when the Fed starts raising rates to curb inflation? Mortgage payments are double or triple. Debtors collapse, they cannot pay what they should have paid. Those families who barely made ends meet saw their monthly payments double, and that's where the defaults begin. Since everyone wanted to sell at the same time, house prices plummet. The bank is no longer in the situation it used to be, when they said, house prices are always going to go up. Of course, they did not foresee this situation in which everyone, absolutely everyone, wanted to sell their houses at the same time. The bank could no longer get its money back by selling the property. The system ran dry. Lehman Brothers was the first to fall, but fear spreads to the entire planet. The collapse of liquidity occurred because no one knew which banks had that garbage on their balance sheets. Credit between banks is frozen due to mistrust. The government bails out Fannie Mae and Freddie Mac, but lets Lehman Brothers fall. Total panic. The S&P 500 is down more than 40%. Now what's the problem? In 2007, Ben Bernanke, chairman of the Fed, said that the impact of subprime was contained. Nowadays we often hear that certain macroeconomic risks are under control. History teaches us not to blindly trust the official story. In 2008 it was the CDOs. Today we have complex derivatives, massive leverage in the shadows of the financial system, and private debt markets that grew exponentially without the same regulation as traditional banks. When all markets rise driven by a single narrative, as sometimes happens with fashion sectors, which today could be artificial intelligence, systemic risk increases. If that narrative stops, you face it head-on. So, what is the greatest lesson that 2008 leaves us? It's not that we don't invest out of total panic, no. The issue is that we have to know exactly what we have in our portfolio, that is, not blindly trusting the labels of the funds. Look at the underlying assets, i.e. the assets that underlie what you are buying. Always maintain a real diversification and, above all, do not get carried away by euphoria when the market seems to ignore the risk. Crises recur because human psychology does not change. Greed always clouds reason before crash. So, look at the mutual funds you have, the ETFs you have. What's inside? You have to lift the hood to see what's inside, right? Be careful with closed products. Let's see what they contain. If this historical analysis helped you and you want to continue protecting and growing your capital with your feet on the ground, subscribe to Konovan Finance. Leave me in the comments. Do you think we are close to a major correction or does the market still have rope?